accounting cycle. Now, we need to know what does this mean? What does this term mean? Accounting cycle. Accounting cycle is nothing but it is a process by which this whole procedure of accounting is done. Means it includes certain steps that are being undertaken to complete the cycle of accounting. Now, what are these? First and foremost step is identifying and journalizing. Now, you will ask me again, what do you mean by this thing? Now, in my earlier example, when a mother gave some money to his child to have some vegetable from the market, he spent certain money 10, 20, 10, and he was left out with 60 rupees. Now, this was a series of transactions that the child has gone through. Now, here, firstly, we need to identify what are the transactions that need to be recorded. Means, what are the economic transactions that will have effect over the decision things of in an organization. In this example, these economic entries will be recorded. For being recorded, these need to be firstly identified. Then a journal entry will be passed for each and every economic transaction and will be recorded accordingly. Now, in a better language, we can say that all the monetary transactions are identified and journalized in the very first step of accounting cycle. Now, again, for example, how we will now see the mother has given money to the child, and after just give the information, the child has given the information that on 10 rupees I have taken potato, 10 rupees I have taken onion. Only the verbal commitments are there. So, but in accounts, we need some actual documents that will show that certain monetary transaction has happened. For example, in an organization, in a month, there is various expenses. For example, electricity, stationery, salary paid by the company to its employees, other expenses which are done on a regular basis. Now, how will I be assured that this is an electricity expense, this is stationery, this is salary, these are everything will have a source document which will show that this transaction has taken place. In the case of electricity, we will have a bill issued by the Electricity Board of Second, from stationery, we will have bills from shops that something has been purchased from the shops. Salary, we have salary slips. And similarly, other expenses also have certain source document. These are also called vouchers. In accounting information, source document that shows that some economic transaction has taken place in an organization, these are called vouchers as well, and on that basis we identify that these are the monetary transaction and we may journalize them. Journalize means recorded in a specific manner. That is the language of accounts. So this is my basically first step of accounting cycle. Now, second thing is posting and balancing. Now, in the very first step, we have identified the monetary transaction. We have passed a journal entry for the same. Now, we are secondly will take these entry to their specific ledgers. Means, in my previous example, I had expenses related to electricity, related to stationery, related to salary. Now, every month, in the month of starting with April, May, June, we have entries for the same. Similarly, transactions for stationery, similarly for salary. So, every month, whatever be the entry will be passed for specific expense, they will be posted to their specific ledgers. For example, in the month of April, I had 10 transactions related to stationery. First, two, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10. Now, in first, I had 10 pens that costed 100, 20 pencils that costed 20, 10 erasers that costed 10, 20 notebooks that costed 200. Let's take 5 only. 5 sharpeners, say 20. Now, for each transaction, we need to pass a journal entry. Okay. Now, every time an entry will be passed, it will be posted to its ledger. Means this 100 will be posted to the ledger, 20, 10, 200, 20. Now, this whole will come to as 380. This is called balance. After all the transactions are posted to ledger, the final balance is taken out. This is called balance. Now, first we had identifying and journalizing. Second, we had posting and balancing. Now, what is the third step in accounting cycle? Preparation of trial balance. Here, when ledgers have been made for each and every head of expense or income, a trial balance is prepared. Posting and balancing.
In my earlier point, what we done? We had identified and journalized the transaction that has been undertaken in an organization. Now, after the journal has been made, these entries will be posted to the respective heads. Let's have an example for this. Suppose in a month, say the month of July, we have expenses named as electricity, printing and stationery, and other expenses. Now, electricity had in the month of April 8,000 rupees, May 9,000 rupees, June 10,000 rupees. Similarly, stationery 800, 900, 1,000. Similarly, other expenses were 2,000, 4,000, 6,000. Now, the respective expenses were made into different heads in different months. Now, what will happen to these things? They will be posted to their respective ledgers. Means we have to make ledger of electricity, printing and stationery, and other expense. For every month, April, May, June, the posting will be there as like 8,000, 9,000, 10,000. Similarly, 800, 900,000, and 2,000, 4,000, 6,000. All right. Now, फिर after that we will do the balance. This balance will be carried forward for the next month. Say for April we had the balance of 8,000, we had the balance of 800, we had the balance of 2,000. Now in May our balance was 8,000. Again May we had 9,000. Now the balance will become 17,000. Similarly for June the balance will become 2,000 to 27,000. In this manner only, cumulative total will be done for whole year, and we will come to know how much expense was made under a specific ledger for whole year. This is called ledger posting and balancing. Now, we have the third point after posting and balancing as preparation of trial balance. Now, what is trial balance? Here, after having the balances of each and every head, we will make a trial balance into which we will write all the balances of each and every head, whether it is positive balance or negative. For example, positive will be like assets. Asset means that are for future use of future purposes. For example, plant and machinery, any furniture and fixture. Similarly, we have debtors. Debtors, the person to whom we are selling the goods and we need to recover money from them. We will have the balances of them. Similarly, we'll have liabilities. Liabilities means the things we need to pay in future. as like creditors to whom we have purchased the material. Loans, we will put all the balances and accordingly we will have a preparation of trial balance. Now, the next thing we have, fourth point. Firstly, we had identified and journalized the transaction that has been undertaken within an organization. Second, we have posted and made a balance out of it. Thirdly, we had prepared trial balance. After that, we will prepare trading account. Now, what do you mean by trading account? Here, after the trial balance is made, a trading account need to be made in the next step. Here, whatever the expenses which are direct expense and direct income are recorded in this account. And if direct expense more than income, we have gross loss. In case direct income is more than expense, we have gross profit. Let's have a example for this. Suppose this is the trading account. Here, purchases made will be recorded over here since it's a direct expense. Any wages paid to the laborer for the manufacturing concern. Freight within the factory. Now, sales made during the year. Suppose purchases were made for 10,000, wages for 1,000, freight for 2,000, and sale was 20. Now, the balance will be 20. Now, the balance of these three heads is 10, 12, 13. Now, this means expenses are less than sales. We will have gross profit as 7,000. In case we had expenses more than sale, we would have gross loss. This is what trading account is. Now, moving to the next step of the cycle, we have P&L account, means profit and loss account. What is this for? Here, the indirect expense and indirect income are recorded. And similarly, if expenses are more than income, it is net loss. In case the income is more than expenses, it is net profit. For example, what could be the indirect expense and indirect income? The expenses and income that are out of the factory gate, actually. For example, salaries paid, conveyance charges paid, selling and distribution expenses, Diwali expenses, all such expenses will be recorded here as these are indirect. Now, sale of scrap means in case you are selling some scrap material from your organization, the income would recorded on P&L account since it's not pertain to your organization directly, it's an indirect income. So, after balancing, if the balance of and in firstly we need to record the gross profit or gross loss. In case we have a gross profit, it will be transfer over here, and in case we have gross loss, it will be transfer over here. Now, gross profit here, the total will come. If it is more than the expenses, we will have net profit. And in case we have more expenses than sale, then credit side, we have net loss. This is what profit and loss account is. This profit and loss account will tell you about the actual position of your organization during a year that has been done out of all the transaction that has been carried out within an organization. Now, after preparing profit and loss account, we have the final step of making balance sheet. Now, why the balance sheet is made? Balance sheet is the mirror of the company. Means with the by seeing the balance sheet, people can assess how the company is working, company is making profit or not, what are the type of expenses the company is having, what type of income it is having, whether they are incurring indirect income in a large scale or they are having direct income. This is what balance sheet shows. Now, PN after making PNL account, we will make balance sheet. Balance sheet will have the balances of assets and liabilities. Means assets means plant and machinery, furniture and fixtures, debtors, cash, bank balance. And similarly, liabilities will have creditors, loans, and here is the term capital, that is for the owner. Means the owner have invested something into the business, it will be the liability of the business. This is what balance sheet is, and the balance of both the side must always match, then only you can say that balance sheet is correctly made.